If you enjoy deep stock breakdowns like this, make sure to hit the like button and subscribe for more financial insights every week. It helps the channel grow and keeps you ahead of the market. Apple reported its Q2 2025 earnings with a mixed performance that left investors divided and led to a modest drop in the stock price. Revenue came in slightly below consensus at $118 billion United States dollars, down 2% year-over-year, as weaker iPhone sales and continued sluggishness in China offset growth in services and wearables. Net income still beat expectations at $26 billion United States dollars, supported by improved margins from Apple's services and cost discipline. However, the market reacted negatively to management's cautious tone regarding China and soft forward guidance, which hinted at flat revenue for the next quarter. Despite this, Apple remains a fundamentally sound company with a fortress balance sheet, consistent cash generation, and a loyal ecosystem that supports long-term value. From a technical perspective, Apple stock recently broke below its 200-day moving average, signaling short-term weakness. The relative strength index sits near 35, indicating oversold conditions. The next major support zone lies near $170 per share, while resistance sits at the recent high around 192. A failure to hold above 170 could trigger further downside, but momentum could quickly reverse on any positive product or macroeconomic news. Volume spikes on down days suggest caution, yet institutional holders remain largely committed, implying longer-term confidence. Fundamentally, Apple continues to deliver strong gross margins at over 45%, with services now contributing more than 25% of total revenue and growing at high single-digit rates. The installed base of active Apple devices has surpassed 2 billion, and average revenue per user is expanding, especially through Apple TV+, iCloud, and Apple Pay. Management's emphasis on generative AI integration across iOS, macOS, and Siri provides a long-term growth lever, although current monetization remains in early phases. The iPhone 16 cycle is expected to be modest as consumer refresh rates lengthen and competitors gain market share in China. But the launch of new AI-powered chips and an expanding wearables segment should stabilize hardware revenue. Apple's ability to increase average selling prices, even in mature product categories, underlines its pricing power and brand loyalty. On the cash flow front, Apple generated nearly $35 billion United States dollars in operating cash flow for the quarter, up year-over-year. Capital expenditures remained stable at just under $3 billion, supporting consistent innovation and infrastructure build-out. Free cash flow came in at $32 billion United States dollars, reaffirming Apple's ability to fund shareholder returns comfortably. The company returned over $24 billion United States dollars to shareholders through a combination of dividends and buybacks. Its balance sheet remains robust with over $60 billion United States dollars in net cash, allowing Apple the flexibility to pursue strategic investments or acquisitions without raising capital. The SWOT analysis shows Apple's core strengths in brand loyalty, ecosystem integration, and innovation pipeline. Its weaknesses include reliance on iPhone revenue and geographic exposure to China. Opportunities lie in AI integration, wearables, and health tech, while threats include increasing regulatory scrutiny, global macro uncertainty, and competitive pressures from Android OEMs and Chinese tech firms. Apple is increasingly positioning itself as a platform company rather than solely a hardware business, which may help to risk cyclicality over time. Management's forward guidance indicated flattish revenue growth for Q3, with seasonal tailwinds expected in Q4 tied to new product launches. Executives acknowledged continued weakness in China, but emphasized resilience in Western markets and growing traction in India and Southeast Asia. The company expects margins to remain above 45% and highlighted incremental AI-related services monetization beginning late 2025. While not overly bullish, the outlook suggests stable fundamentals with a cautious macro overlay. Despite near-term headwinds, we maintain a buy recommendation on Apple. The stock currently trades at around 28 times forward earnings, which is a premium to historical averages, but arguably justified by its dominant platform, strong cash flow, and long-term optionality from AI, services, and health tech. The recent pullback offers a better entry point for long-term investors. While volatility may persist, Apple's fundamentals remain intact, and its ecosystem continues to deepen. Long-term investors with a 5-year horizon should view this weakness as an opportunity rather than a red flag.